Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss how to estimate your expected retirement income. Specifically, I'm going to chat about the average income replacement rate for people entering retirement, 3 common reasons your income needs may increase or decrease in retirement, 4 key tenets to guide a 30-plus year retirement income plan, intertwining your retirement income plan with an investment and tax plan, the first place to start when formulating a retirement income plan, and lastly, a few action items for you to consider. So today, let's discuss how to estimate your retirement income needs. I will be drawing some information from an academic study by Marlena Lee titled The Retirement Income Equation: Understanding How to Arrive at a Target Replacement Rate. If you'd like to view the technical data and drill a little bit deeper into the subject, I encourage you to check out the research study. I've included a link to it in the description. So, for those of you within 5 to 10 years of retirement, having an understanding of your expected spending in retirement is incredibly crucial. Developing this number will help you finalize a feasible retirement date, help to determine any additional investing needs to help you reach your retirement goal, help you map out those first few years of retirement spending and what it might look like, and help to unearth other potential gaps in your retirement plan. Now, as a certified financial planner, knowing this number helps us create a baseline financial plan, and then stress test that plan with different variables like savings rates, inflation, and the impact of a deep market correction on your ability to fund your retirement. However, I think the most difficult part of this process, determining what you will be able to spend in retirement that could last over 30 years, is that we don't have a crystal ball. And attempting to predict what those 30 plus years could look like is really difficult to comprehend. This is why we developed the Fundamental Retirement Plan process, to help provide clarity and vision into what the future may have in store. So the question, how much income in retirement is enough? For most people, the replacement number can range between 58% and 82% of pre-retirement income. So as a nice easy example, if your household pre-tax income was say $10,000 a month, your retirement income need could vary between $5,800 and $8,200, which in all honesty is a substantial gap and doesn't really help narrow down what makes sense for your household. Replacement rates vary because every household is unique. However, for high-income households, these replacement rates tend to be on the lower end, as higher income households tend to reduce spending in retirement and their household tax rates typically decrease. Now, when you think about your future retirement income, I first want you to think about your current household pre-retirement income, the income you generate while you're working. If your current monthly household income is, say, $15,000, and you want to replace this full amount in retirement, you would be seeking a replacement of 100% of your pre-retirement income. Now, common sense would tell us that most people replace less than 100% of their pre-retirement income. See, while you're working, income goes to 3 things: taxes, savings, and spending. However, for retirees, they typically pay fewer taxes and no longer need to save for retirement. So, in a simple example, if your average savings rate was 10% and your average household tax was 30% while you were working and 20% while retired, an 80% replacement rate would be required in order to achieve the same level of spending. Now, going back to our numbers, this would mean that of the $15,000 in pre-retirement income, you would need to generate $12,000 pre-tax of retirement income to achieve the same level of spending enjoyed before retirement. Now, every household is unique and there are no one-size-fits-all percentages. So let's drill down on a few other factors other than savings rates and taxes that may impact this replacement percentage. One significant factor is the elimination of debt before retirement, which I would argue is very crucial for long-term retirement success. For those of you who plan to eliminate this liability before retirement, your replacement percentage will drop significantly as there's no more need to make mortgage payments as you enter retirement. For others, they may want their spending level to remain the same or perhaps increase slightly as they want to enjoy their health and travel as much as possible in those first few years of retirement. Or perhaps you believe your standard of living could still be maintained while be spending slightly less in retirement, causing that replacement rate to actually decrease. Step 2 of our process is to help drill down on this retirement income dilemma and help to refine this replacement percentage, as it's never really a black and white answer. We believe determining this number and honing in on a sustainable retirement income that can be relied upon for 30 plus years should be guided by 4 key tenets that remain central. First, we want you to be able to live off multiple streams of income, whether that be investment income, CPP, OAS, rental income, and future property or business sales. Looking at the complete picture will give you an accurate representation of what a sustainable withdrawal rate from all these investments could be to help you maintain your standard of living. In episode 22 of the podcast, I dig a little bit deeper into this concept. The second tenet is that we want you to live primarily off the investment income produced by your principal investment. Now, this isn't always the case for retirees, and if you find yourself in a position where you'll need to draw down on portions of your principal, I urge you to create a retirement income plan that will give you vision into the future. If adjustments need to be made, it's best to know about them today and not be blindsided 10 years into retirement. The third tenet of a well-thought-out retirement income plan is to ensure your income is increasing throughout retirement to keep pace with inflation. Over the span of a 30-year retirement, the impact of inflation cannot be understated. Going back to our previous example, if your pre-tax replacement rate is $12,000 of household income, that number indexed at 2.5% for inflation means your required pre-tax income to maintain the same standard of living would balloon to $25,000 a month. And lastly, the fourth tenet to your retirement income replacement rate is that you want to have your income as tax efficient or as tax-free as possible. Every pre-tax dollar of income you use in retirement comes with a tax bill of some sort, and at some point, that must be paid to CRA. Now, by using a more strategic approach and targeting specific tax brackets and areas of the tax code, we often find that we can utilize options available that can literally save you, hundreds of thousands of dollars in tax, depending on the size and composition of your overall portfolio. And that is essentially found money that we can then use to address many other retirement questions and issues in the near term or later down the road. Now, going back to our example one more time, if your average household tax in retirement is 25%, not 20% as discussed, this would mean that you would be required to withdraw an additional $750 a month out of your investments to maintain your replacement rate. More money out of your investments on a monthly basis means less growth, less flexibility, and more risk to your ability to stay retired. Now, proper income planning is intertwined with your investment and tax plan, which are 2 steps in our fundamental retirement plan process. An investment plan and tax plan provide visibility into the future, which in turn helps you refine a sustainable retirement income. And it is this visibility that will enable you to understand how your decisions today will impact your future. And done correctly, income planning can give you confidence that you're making good decisions. So to start, I encourage you to start mapping out a budget and having a look at your current spending, taxes, and savings. Are there any large expenses like a mortgage or helping the kids out that will drop off in retirement? What about travel or renovations? This may increase your spending and drive up your replacement rate for those first few years. I encourage you to listen to episode 11 of the podcast where I lay out some budgeting options to help you drill down on this number. One thing I always mention to clients is that your spending is one of the only financial aspects that you have control over today or in retirement. What happens with inflation, the markets, interest rates are completely out of your control, and it is only your spending that can be modified to some extent to help ensure you can stay retired. Okay, so that'll do it for today. 2 action items for today's episode. First off, as I mentioned, jump back to episode 11 and episode 22 of the podcast to dig a bit deeper into budgeting and creating a sustainable retirement income. And number 2, if you're seeking some guidance to help drill down on this replacement rate, I encourage you to check out our website, fundamentalwealth.ca, to learn more about the fundamental retirement plan process. Okay, so that'll do it for today's episode. For all the links and resources discussed, check out the show notes. If you're enjoying the show, please subscribe and leave us a 5-star review. If you haven't yet, be sure to sign up for the weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.